Hello, peeps. This is Sly here, and today is day 4 of our Sly Foundation series. So, on day 4, we're expecting that what we'll do is the Y of SLY, right? Yeah. So, we're going to be looking at entry timing so that we stop chasing and start waiting. Because right now you understand structure, you understand liquidity, but where exactly do you enter from? That's the question we're trying to answer. And at the end of today's lesson, I would expect you to be able to understand why most entries fail. I expect that you would have learned the importance of patience, the difference between a setup and an entry. You would be able to understand risk to reward. And by the end of this lesson also, you should be able to wait for confirmation instead of just chasing price movement. So let's kick off. Most traders don't lose because they cannot find entries. So they lose instead because they enter too early. You might be entering the trade in the correct direction, but entering it too early. So today we are going to learn how to stop chasing that market and start waiting for the trades themselves to come to us. Now, I said you're going to know the difference between a setup and an entry. Now, look at it this way. A setup is a reason to be interested in a particular price movement or chart. An entry is a reason to participate. For example, just because you've identified a bullish trend or a bullish structure, it doesn't mean that you should just buy immediately. Let's look at this chart on my screen. This, for instance, is bearish right now because simple structure marking would show you external swing high, swing low, swing high, swing low here, right? Then another swing high here, swing low. And now this is a retracement phase. Liquidity here has been taken. Now, where exactly would you be? Let's get this marking correctly again. This is the most recent range that we should be interested in. We have seen the structure to be bearish, so we are interested in this market, and our interest in this market is that we are looking for sells because the market, of course, is bearish. In a bearish market, we should be looking for opportunities to enter sell entries. Now, here is the setup. The setup is this range, high here, the highest high being here, and then the lowest low being here. Our reason for wanting to participate in this market would be that price has gotten to the point where we are interested in it. That is what most traders call point of interest. Sorry about that. Point of interest, right? So we have seen structure, liquidity has already been taken here by the break of this high. Liquidity was taken. Now, where exactly will I be interested in entering this thing? Look at this whole zone or area. That whole zone looks like price was moving up at some point there. At the peak of this zone is where this whole downward move commenced from. So there are different names you could call that. Some people call that a supply zone. Some would call it an order block. The whole of that zone would be the order block because this is like the last upward movement before the intentional downward movement. Now remember, I think from the first video or so, I said when price is moving in a trend, we have the impulsive move. Now this is a downward trend. We would have an impulsive downward move and then a retracement upward. Impulse again, correction or retracement, impulse like that, impulse like that continuously until price now changes the trend to now become maybe bullish, or yeah. So if there is a change of trend in a bearish market, it is changing the trend to bullish. Now, why do traders get trapped? We have already seen that the structure is bearish. We have observed that liquidity has been taken. Now, for example, price starts moving downward and you just jump in. Then market, let's say the price is moving downward, down to this place. Then you have seen this downward move, which is the impulsive move. Then you just jump in on a sell trade here, and then price begins to retrace on you. What would that mean to you? That would mean that price is already taking part of your account balance and you are losing. The proper thing would have been to just wait instead of just jumping into trades. You are correct to want to sell on this particular market because the price has shown you structure that is going downward. But in this case, if you had entered a sell somewhere here, or let's say even here, you get stopped out. And then at the end of the day, the market will get to the zone where you're supposed to enter from, and it will start making your expected move. The problem is not about the analysis. The analysis was right that the price is expected to go bearish, but the timing was what was wrong. So this lesson alone can save you a lot of money. Now we get to the next session of this, waiting for confirmation. Have we really gotten to that? Have we really gotten to that? Okay, before entering, the structure must support your bias, liquidity must make sense, price must reach your area of interest. Okay, I think we should focus more on area of interest here though, because confirmation might just be the next thing we should talk about on the fifth day. Right? Okay. So let's look for another example. Perhaps I should even take another asset. I should take another asset. Let's look, for instance, at volatility 51s. Okay, on this chart, we're looking at a different bias. In the previous one, we were looking at a bearish market, right? But this case, we are looking at a bullish market. Now, here's what price is doing on this chart. We've had price move like this, up here, down here, then up here to give us this high, and down here to take out this liquidity, react off of some area of interest, continue upward, breaking this guy, breaking this high here, leaving here as a low, then creating this low, continue, low, continue, and then creating this and continuing like this. Now, this impulsive move has given us this low, which acts as liquidity. Firstly, structure has shown us upward movement, right? We are interested in this market, and our interest right here is to buy. But we will not just start buying at any position. We have to see that liquidity has been grabbed, and that is what this retracement move is doing. It has taken liquidity. Now, do we just say because liquidity has been taken as well, we should just jump in on the trade? No, no. We will not just ignore everything. Our framework is S, which is structure, L, which is liquidity, then Y is this yield zone. That is where we would be interested in price entry. Now, if we look at this whole area, this place being the low, sorry, this place being the low, and this place being the high. Let me mark those two spots off out with with a line to if I place a line there and just copy the line, bring it down here, mark this low. Right. So within that range, we have this liquidity. Price has now come and taken the liquidity. Where would I be interested in following or continuing this price upward? Because this is my expectation. My expectation is that price should come and break this high. Price should respect this low, right? I would be interested in entering this market from this area here. Some people will call this area a demand zone. Some would still call it a bullish order block. Whatever you call it doesn't really matter to me. Mine is what it stands for. It stands for the last selling pressure before the impulsive buying pressure and takeover to continue the trend. So that is how you should be looking at the market: structure, liquidity grab, then um, price getting into your point of interest or area of yield zone. That is what we should call this place: yield zone, which is the Y for us, or YZ, however you want to call it. So you see that somehow we have pieced together everything that we have learned from day one. Day one was asking, why does price move? And we answered that question, that price moves because of the existence of buyers and sellers, and the existence of an imbalance between buyers and sellers in a particular market. On day two, we talked about structure. Yesterday was day three, and we talked about liquidity. Now we're talking about yield zone, and we have seen how to identify our yield zone both in a bullish and a bearish market. Next thing we need to actually be considering is, okay, price has shown us structure, price has taken liquidity, price has gotten to our yield zone. Now, I'm interested in participating in this market from this yield zone. I need to calculate my risk. How much am I willing to risk on a particular entry? That is what will also determine. You don't need to actually win every trade. You need a good risk management. And we're going to be talking about that on day 5. Now, some common entry mistakes that beginner traders make: you could see a price chart and then the price is moving very fast and you feel like you should jump in, or if you don't jump in, the price is going to leave you and move. That is FOMO, fear of missing out. That is a very, very big mistake, and it has ruined a lot of traders. You wouldn't want to. Okay, another common mistake is ignoring structure, ignoring liquidity. Then some people would not place stop losses or risk too much of their account percentage, chasing candles. So those mistakes are some of the things you need to avoid. Okay, so let's recap again. So far we've learned structure, we've learned liquidity, and right now we just talked about entry timing. That is being patient for price to actually get to the area where you are interested in following it. You are following the price, you are not chasing it. Okay, you are not chasing it. You allow it to get to you, come to you, and then you look for a reason, confirmation here. We're still going to talk about that in on the day 5. Look for confirmation and allow it to do its thing. The price is bullish, you should not fight with it. Follow the trend. Right. Okay, so for your assignment, um open the chart and find a setup that interests you. That is, find a reason to be interested in the market. In other words, what you have to mark out: the structure. You have to show me liquidity, a liquidity that would make sense. Then you have to show me where you would be interested to ideally enter an entry, place an entry rather, and then you post, do a screenshot. You mark it up first, do a screenshot, then you post it on your on the group, rather on our group. Remember that a good trader does not chase opportunities. He or she waits for the good setup to come to him or her. A good trader waits for opportunities, right? So structure, liquidity, yield zone. You have to read the market before you trade the market, right? Okay, I hope that this video has been quite informative, and I hope you've learned one or two things from your people. Remember that the market leaves clues. Learn to read those clues. This is Trading with Sly, and I'll see you guys in the next video. Happy trading, guys. Sly out.